ETFs, or exchange-traded funds, and mutual funds. They're both simple, easily accessible passive investments for those with little time or knowledge to monitor markets. So how do you decide which is a good investment for you? The answer could just be a piece of cake.
ETF is like buying a pre-mixed cake. You will never go wrong, you just need to follow the ingredients or the recipe. ETF-wise, like a pre-mixed cake is almost instant. You can get it anytime, get any supermarket. It won't deviate too much from your expectation. Versus a mutual fund is like going to a store to customize a cake. Like example, I want a chocolate cake with rainbow sprinklers on it. Yeah, so it's something very customized, and the shop will actually do it for you, and they will let you know what's the price at the end of the day. For mutual funds, you have to get it from like a specific distributor with that fund that you wish to invest in.
Mutual funds and ETFs are collective investment schemes that pool investor money into diverse assets, which are then sold as units for a fractional cost. Mutual funds are not listed on the stock exchange and have portfolio managers to oversee the fund's asset holdings. But ETFs, which capture the performance of benchmarks like the S&P 500, can be bought and sold like stocks.
Typically, ETF, it could be as low as just one unit of the fund, especially if it's listed on US and some SGX listed ones. So with less than $100, you can exposure to a very huge basket of companies, between 30, 500 to 2,000 or 1,000 over companies. Yeah, for mutual funds wise, the initial investments is also very low. It's as low as $100 as well.
To get started on ETFs and mutual funds, investors need to have a trading account with brokerages or online platforms. They must decide on which currency or geography they want exposure in. Then assess their risk tolerance and which types of funds will meet their investment objectives.
The Singapore investor just close the eye, just buy STI ETF. Because there's a closest to us and we know what's happening in Singapore itself. And the other thing would be the REIT ETF. If they want to invest regularly for every month, maybe $500 or $1,000 would be a good starting point. Especially for fresh grad. For the mutual fund itself, I would suggest they have a minimum $2,000 to start off.
Investors have several payments options when investing in ETFs and mutual funds, but there are costs to take note of.
Fees-wise, ETF is very attractive because of the low expense ratio. Typically, for instance, in passively managed ETF, usually the expense ratio is under 1%. So that means if you put $100 in the portfolio, about less than $1 is going into the fund managers to manage these, to set out or create this ETF. Whereas for mutual funds, typically it ranges from 1 to 2% to manage that fund. So essentially, in a longer time, especially if you hold for a very long investment horizon, sometimes these fees may eat into the portfolio. And also during when fund managers actually underperform the benchmark.
So active management of mutual funds comes with a higher cost. But that cost could pay off, as active management could have the potential for higher returns. Although, once again, outperforming the market is not guaranteed even with active management. In contrast, most ETFs are index funds. This means they just match the market return.
So mutual fund, there's a flexibility, and also a fund manager itself that can react the market much faster. But for ETF itself, when there's a market crash, they will follow the whole market crash together because there is no human intervention.
Year to date, the top 5 performing ETFs on the SGX are tracking gold and Asia-Pacific markets.
Most of the ETF, they are either offer the equity focus or maybe a fixed income focus. But mutual fund itself, they have a much more flexibility. they can have different composition. For example, they can have 100% in equity, 100% in fixed income, or there's a blended combination. Definitely the aggressive portfolio, which means that there's an allocation to 100% equity that will offer the highest return. But at the same time, the investor must have a strong heart to really take the drawdown during the market volatility.
As they are diversified, both ETFs and mutual funds have lower risks than buying individual stocks. But like all investments, they are not risk-free.
The ETF is supposed to just track an index. They are not supposed to outperform. For mutual funds, technically there is a smart person that's doing this homework for you. So that's why you're paying them more fees to manage this portfolio more efficiently. Both of them are investments, assets in nature. So volatility risks and also the liquidity as well, because if you need the money, sometimes the liquidity only comes back to you like, let's say, 2 or 5 business days later. So sometimes there's such a risk involved. And also the FX risk, depending on the underlying assets of the products.
Although the ETF and mutual fund, they are diversified, there's one big risk, which is an issuer risk or fund manager risk. Issuer can go bust, fund manager can go bust, or due to whatever reason they decided that do not want to continue the ETF or mutual fund.
Despite such risks, ETFs and mutual funds provide good starting points for wealth building.
Investing in ETF or unit trust or mutual fund itself enable you to free up all your time and have a very diversified portfolio. Make sure you buy it cheap. Make sure you don't buy anything when the market is on a downtrend, right? If you buy it cheap and when the market is going up, over the long term, you should be able to make money.